We're going to get some food in you as well, maybe get a little snack, keep the brain going. This next section that's coming up is the squats and reversals on page 303. This section will last about a half an hour. Yep, just a little bit over half an hour. And then we will have one last section to go, which will be over an hour for the last section. So just to give you a little heads up, that will be a 5-minute break in between. And also, just to remind you, when you do type any questions, have the page number referenced here. Do want to also make sure I didn't clarify, make sure the questions that would be typed in for today would be for today's session of day 3 only, not questions reverting back to day 1 or day 2. All we would be looking for today would be questions about today's material and presentation. So that would be starting from page 245 on the primary base section going forward. And I'm looking at some of the questions here. We'll get you some more information as to um, any other details about the question and answer. All right, so with that said, let's get started then. Page 303 with squats and reversal recoveries.
Okay, 2020 Master Trader Program Super Performance Workshop. I'm here with David Ryan, and we're back. We're going to cover and go over selling rules now. This is selling at a profit, taking profits, some of the sell rules that you want to look for when a stock is getting itself to a point at which you should start looking to sell into strength, and then also selling into weakness. There's two ways that you can sell. You can sell into strength, or you can sell into weakness. Selling into strength is getting out while the getting is good. Selling into weakness is using some type of trailing mechanism that when it closes below or penetrates below, that you use that as some type of stop. I very often use a backstop where I just put a stop up behind the stock to a percentage that I want to capture. So for instance, if the stock breaks out, it goes up 15, 20%, I move it up to 10. Maybe it goes up 25, 30, I move it up to 20, and I just backstop it. That's a little bit different than a trailing stop. A trailing stop would just automatically move with the stock and stay a certain distance away. A backstop I manually put in and then I adjust it. So that's one way. We're going to talk about how to identify when a stock may be topping. And there's 7 areas that we're going to look at here. The base count, we're going to look at PE expansion. I told you PE I don't really look at much, but there are a few instances that we can use PE to give us some guidance. It's not anything that's very specific in timing, but we'll show you that in just a second. Talking about climax price action and counting number of days up, reversals and churning, looking at largest breaks, and also down on largest volume. These are some of the signs that you will find when a stock is topping, and it's uncanny on how you'll see this over and over and over. Dave, we've looked at literally millions of charts, and we've studied these things. It seems like there's not a lot of things that a stock will do when it tops. It sort of shows the same signs over and over. How do so many people get so caught up in a stock that's I guess running up? I guess you get at a profit and everybody gets real excited and they don't see these topping signs.
Yes, somebody described it as like a moth that's drawn to light, and it just becomes more and more attractive the brighter it gets and the more focus there is on it, but then it ends up singeing the moth and the moth dies. I mean, it's just people are attracted to names they've done well in and they talk about, and other people are attracted, and that's lots of times what happens when you get into climactic price action. But the most important thing about all these points is that you're an observer of change. You're looking for change. Is the stock when it's going through that that stage 2 price move? Is there something different about the way it's acting from what it's been doing for the last 2, 3, 4, 5 months or longer? And some of these things start coming up, and they start sort of adding up as the time goes on, and when you get to a number of these different characteristics, that's usually about the time you get to a top.
Yeah, change in character, looking for character change. And you'll see a real shift in character. We're going to show you that in just a second. And this is why we have rules. This is why you can get caught up. You know, you get a stock that's profitable and you're doing really well in, you have to have some objective rules. So we're going to give you those. And we're going to start from, again, sort of pulling back and looking from an aerial view again, and a broad view. When we look at a stock and we're trying to identify if it's put in we're talking about a top here, a pretty big topping phase where the stock is now going to underperform, go sideways or down for an extended period of time. When that stage 2 move is over, at least for the time being, and you're going to have a significant correction or a significant amount of time of not going anywhere. So the first thing, and this might be something that you've heard before about counting bases, and I know Dave and I have talked about this, for all the years that we've done the Master Trader Program. We both agree that it is somewhat subjective, and that you have to get good at even knowing what is really a real base. And then again, there's no magic number. But what we found is that when you get into you're in the stage 2 uptrend, and I'll get my pointer here, and the first few bases are really investment grade bases, because you're starting a new trend and you're pretty early in the move. And then when you get to you start getting into 4th and 5th stage bases, and certainly 6th stage bases, you have to start looking for the signs that, you're getting very long in the tooth, and you start looking for these more specific sell signals. But it doesn't mean it can't happen on a 3rd stage base, a 4th stage, a 5th stage. So it's really just giving you some perspective as opposed to really specific rules. So, and again, you're going to look for not only just counting the bases, but the actual price action, and getting more, zooming more in on what's actually happening on a daily basis as well. But the first thing is to just count the bases. Where are you since this move started? So you have a stage 1. When you get into the stage 2, the first viable base, that's your base 1. Here's 2, here's 3. This is Amgen going back in the 90s, going from the 80s into the 90s. And this was a really big move that it made, bull market move coming off of the 1990 bear market. It was a key leader. We showed you this earlier. And then you can see when it gets later stage, the base gets a lot wider, and it gets looser. And of course, it rolls over and fails and goes into stage 4 at some point here. Again, like I pointed out, this is Yelp coming out from a new issue. Here's an IPO. And it's pretty much all over the place. But then you get into a stage 2 and you start getting these tight bases, and you get buy points. Now, again, 1, 2, 3, and you get to this 4th base, and you see it's a big base with a lot of the action below the 40-week or the 200-day moving average. And you're starting to get into that stage 3 now, which gets it could be a stage 1. I mean, you could go from stage 1 to 2, move sideways and base for a long time, and go back into 2. That's possible. You're only going to know in hindsight. But once you start getting these signs that you could be either in a stage 1 or a 2, or a 3, now you're either moving sideways or transitioning into stage 4, moving down. And those are 2 scenarios that you don't want to be in. You don't want to be wasting time or losing money. You want to be in that stage 2 uptrend where that's where the big money is made.
Yeah, and what I would like to add too is, as you said, as you get along in the move, the corrections within the base get bigger and deeper, and the volatility picks up. You start having a stock that used to be very, very tight throughout its move, starts having wider and looser types of swings. The other thing to keep in track of is also how far the stock has gone over this last 9 months, year and a half. And you see this Yelp example going from $30 a share in base 1 all the way up to $100 a share in base, at the top of the move. And see, as you get along, as it goes up, you have to ask the question, how many times has this stock doubled? Or because there aren't that many stocks that double, and there's not that many stocks that triple. But when you get a stock that goes from, this is more than tripled, you have to start thinking to yourself, how much more do I expect to get out of this stock. And it's just something to keep track of as the move is going along.
Right. So character change. And also what Dave is saying, he's not saying tripled from the lows, but from that first base, that first viable base. You're starting to count this and to calculate this from the first viable base. Because a lot of times you'll get a move that before you get that first base, you'll get a double. You'll get a double or even a triple. And then you start getting those viable bases. Now you're in the stage 2 uptrend. You've got that, you've got that inertia, you've got that momentum. And then from there, when you start doubling from there several times, then of course you have to start looking for those specific signs and looking for the volatility. Now, a few things to point out. I'm just going to real quick. These are stage 3 characteristics. I'm not going to go over this slide. This is page 320. We're going to move on to the next slide, but these are just showing and talking about the characteristics of stage 3. And of course, we've talked extensively about stage 2. So one of the things that you can look at, and this doesn't always show up. Occasionally, you'll get where you can count bases, and you'll see the PE expand, where the stock grows faster than the earnings. We talked about this earlier when we talked about fundamentals on how does it when the stock goes up 200% and the PE is the same? Well, because the earnings went up 200%. But what happens when the stock goes up and the PE was at 20 on the first base right here, and then you've gone through second base, third base, fourth base. Now you're coming up, setting up in your fifth base, and you go and you look at the PE, and the PE is now doubled. What that means is now the stock has outpaced the earnings by twice the amount. So the stock is running ahead faster than the earnings. And this is the opposite scenario that we had before. And again, if the combination of having a PE expansion of 2 or more times and late stage bases, you really got to start taking a look carefully and looking to see if you might be chasing something that has already made a big move. Now, here's Lumber Liquidators. We previously, we just looked at deck here. This is Lumber Liquidators. You see Lumber Liquidators, similar situation where you get 1, 2, 3, in this case, 4 bases. And you got this really, again, this fourth one was pretty sloppy. We actually analyzed that earlier. That was that failure that I talked about. And then they actually tried to set up another base here that was very sloppy. You might even say that this was a 5th base. The PE went from 20 times to 50 times. So more than doubled, and you've got all those bases. Now you start looking for those violations, for base failures, pivot failures, and you're going to take them very seriously at this point, because you could be putting in a major top now, not just a temporary pullback, but and again, I don't think we talked about this before, but let me tell you this, one of the rules that I have, it's called the 50-80 rule. The 50-80 rule states, and this is, just looking at past leaders, and when you get a secular leader, a stock that's made a really big move and was a market leader, when it finally tops, there's a 50% chance that it goes down 80% and an 80% chance that it goes down 50%. And the average decline of these previous leaders is about 75 or so percent. That is an enormous decline. And the real key is that many of these stocks don't come back for 5, 10, 15, sometimes 20 years. Then this is, no matter what cycle you look at, you can go back into the 70s, Eastman Kodak and Xerox topped. They went sideways for 24 years while the S&P went up 500%. You can take a look at Cisco and Microsoft and all the names back that topped in 2000 in the dot-com bubble. And some of them didn't even get to break even now. 20 years later, they're not even back to break even. So here's CMG. So here you see you started with a 20 PE, went up to 65 times earnings. So this more than tripled the PE, and you went 1, 2, 3, 4, and you're on your 5th base here trying to form, and then it breaks down and it tops. You'll find that a lot of these stocks, once they get where the PE is doubled and you get on the 4th or 5th stage base, you're getting late. You're definitely, it's not a stock that nobody knows about anymore. I can assure you that. It's run way ahead of the earnings. It has a lot of bases. It's probably on a lot of people's radar, and institutions will start looking to sell if things start turning bad. And you might not know if things start turning bad because the stock will discount. And when I say things start turning bad, like I said, institutions are looking, they're doing channel checks, they're talking to suppliers and vendors, and they're in there selling even before you get that bad news. Remember, we talked about buying on technicals and fundamentals, and selling on technicals, and not waiting for the fundamentals to catch up. So here's Home Depot. This is actually, I usually tell a little story when I show this Home Depot example. I'll tell you. It's kind of a fun little story. So you can see, first of all, let's just look at the chart, and you can see that the first time that Home Depot topped was when you got this really dramatic PE expansion from around 25 times earnings up to almost 75, almost triples the PE, and then it stalls the stock out for a long period of time here. You can see it really stalls the stock out for 1, 2, 3, 4, or almost 5 years before it gets back into that stage 2 uptrend again. And then again, you can see the PE expands again. And when it finally goes up, 2 or 3 times, and you get late stage, the stock tops. So I was called by George Soros's Soros Management to, they wanted to talk to me about hiring me. And so I went to his office and showed up, and Stanley Druckenmiller was, of course, the portfolio manager, and his guys came out, and he walked into the room and said, "What do you think of Home Depot? We're long. We're heavily long the stock." So I had been looking at this fact that it was, the PE had expanded quite a bit, and I knew Home Depot quite well. It was very popular. As you could see, this big giant move, everybody knew Home Depot, and it was very late stage. And I said, "Wow, I think you're gonna get hosed on that." I mean, I would probably, if I had to go long or short, I'd probably short the stock right now. And so he looked at his assistant and said, "Give that man a check, hire him." And started walking out the room, and then he turned around and put his head back in. And he says, "I just wanted to see if I could influence your decision." And so he was telling me the opposite of what their real position was. He said, "We're actually short the stock." So I gave him the right answer, I guess. But yeah, so I just felt like, this was a very late stage name at that time. And sure enough, you can see when we looked at the fundamentals. If you remember, when we talked about fundamentals, we looked at the contrast between the earnings in this uptrend, and then going forward, the earnings actually were half the growth rate. So the stock discounted that and topped. And again, look at all these years: 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 years later, stock's still significantly down.
And Mark, one thing I would like to say is during this period of 1993 through 97, what's happening is the stock is just going sideways and marking time, and it's almost as if the earnings have kept on coming through, because you can see the earnings, the PE ratio is dropping off during that time. So the company is still doing well, but it's like this. It's in this previous uptrend. It's as if the stock got ahead of itself, and so then just sat out for 4 or 5 years while the earnings kept on coming through. The multiple got low enough, and then it went through another great growth phase in the stock. And one thing I would like to add too is, this is a great company, but you always have to make in your minds the difference between a great company and a great stock. You want both. You just don't want you just don't want a great name because everybody knows it and everybody says it's a blue chip. But you want a great name with great earnings and great price performance. You want all those things together. So just because it's a Microsoft, which sat out for 16 years straight, you shouldn't own a stock just because of the name and who they are, but they have to have those earnings and they have to have that price performance.
That's right. We talked about this before, where a good company doesn't necessarily make a good stock, and a bad company sometimes makes a great stock. And it turns out that it's a flash in the pan and doesn't last very long, but the stock goes up 1,000% or more. We've seen stocks go up, thousands of percent. The .com era was a perfect example. Most of those companies were vaporized shortly after, but there was an opportunity to make a lot of money there. So another thing, we want to look for, and you certainly want to be selling into this, would be what we call a climax run or a blow off top. And sometimes you can get where you get those later stage bases, you really get sucked into the euphoria, because those late stage bases turn into a melt up, and the stock just runs up out of a late stage base and makes a huge move in a very short period of time. So again, looking at this is looking at Stryker. You can see stage one, two, I'm sorry, base 1, 2, 3, 4, 5, all in stage 2, right? Coming out of the bear market, the 1990 bear market right here. And then look at this acceleration. I'm just big acceleration. And again, you're definitely looking to sell into this, or at least backstop. And this is where, if you're fortunate to get a climax run, again, you want to be nailing down your profit into this. And we're going to show you a few rules that you can look at to identify when this may be exhausting itself. Now, a few things. One, you can see that after a period of several years, you reset. You go into stage 4, back into stage 1, and now you start a new stage 2 with a little VCP, cup with handle right here, and you can be back in a name. But usually when you get a major top, they're out for years. They underperform for quite a while. Here's the key here, though. The key is to identify the difference between a breakaway move and an exhaustion move. And this is where it's pretty interesting. And we talked about David's MVP criteria, right? Where when a stock's up a number of days, 11 or 12 days out of 15, that's a very strong sign that the stock is under accumulation. Here's the thing: when you start a move and you first start in that stage 2 uptrend, the things that you're looking for that would be bullish, later on, when you're in a later stage of the move, they're the exact same characteristics are bearish. The neat thing about this is you don't have to change your characteristics. You don't have to change the rules very much. You just look for the same thing that you looked early on, and now it's a sign of exhaustion. So here with Southwest, of course, you have where you come out of that first base, and you can see this is a breakaway move. Now you have a second base, third, fourth, fifth, and now what looks very similar to this move here is now an exhaustion move because it's coming from a later stage. We're going to show you how that looks, and of course we're going to zoom in even more here and show you how we flip these characteristics around from bullish to bearish.
Yeah, the key is to ask the question when a stock is doing this, very strong up move right out of that first base or after that fifth base, is where has the stock been for the last year or year and a half? If it's been running for a year or a year and a half, that means that you're probably going through a climactic exhaustion type of move. If it's just coming out of a long base, a 1 year, 2, 3 year base, that's probably just the start of the move.
Right, and especially if it's coming off of a bear market. If you've got a bear market that has just unfolded, and now you've got these bases that are setting up and going into stage 2, coming off of a bear market low, there's a good chance, yes, you're at the beginning of a move. So always measure against the market. Now, here's Taser. If you remember, I was buying Taser. And again, it looked like, when I was buying it, it looked like, holy cow. I mean, the thing went up, like 12-fold. How much higher can this go? So just because it's going up a lot doesn't mean that you pass on it if it meets the criteria. See, this is not a climax top. This is just your initial breakaway move. And then you start setting up these high momentum bases. Now you get an accelerated advance, stalls it out, and then the climax. So now it doesn't mean that you can't go right into a climax move. This accelerated advance could have been the end of it. You probably should have been selling some there too. But again, you can go through several iterations of these run-ups before the final top is made. So that's why we're going to show you a bunch of things to look for here. Just want to show you a few more of these, what they look like. Qualcomm, here's the acceleration. Right? This is the acceleration. Then it stalls the stock, but you set up another VCP right here, and then you get the climax run. And if you take a look, from here, which is in November, this is just 2 months. This move is several 100% in just a couple months, and it comes in the form of an accelerated advance and then a climax where you go up 73% in just 6 days, right at the end there, and you get the gaps and so forth. I guess when we talk about accelerated moves and stocks that are making these giant nosebleed type performances, I figured we got to look at Tesla, right? And again, this is pretty much up to date as of this month right here, as of the 6th of September. So, you know, look at this long dormant period. You come out. This certainly is a breakaway move. But then you get a big decline here. You get this big bear market decline in the stock, comes back, gets back into new high ground, and you're back into a stage 2 uptrend here. So again, you know, this may be a breakaway move. I say, you know, this is an accelerated move, and we're probably in a climax now. But coming out of a big bear market, this might be your breakaway move. You get an acceleration, and you might get one more. Maybe you get another move that's a climax move from here. And in hindsight, this is an acceleration. No one really knows for sure. But I want to show you some examples of some stocks that I traded and show you, compare the difference between these breakaway moves, and then show you some specific rules to look for and really zoom in on the daily bars. So WR Grace they had asbestos claims, and there was litigation, and when it started resolving itself, the stock was setting up, and I bought this stock coming right out here. We looked at this before, but you can see just in one day it was up 20%. So right there, saying something, that's a big breakout, you know, a really big breakout. Another day later, just in 2 days, up 30%, and in 3 days, it was up 40%. So this is one that, being such a quick move and breaking out and coming off of the market, was coming off a little correction. I didn't sell this right away, and I made a pretty nice move on it by holding it. You can see 55 days later, it was up 147%. So this is a breakaway move right here, right? You're coming out of a nice base, and you wouldn't conclude that that's something that's blowing off here, and you should be selling everything. Now, here's a few things that I look for. So the first thing I look for, and if you're a swing trader and you're trading the short-term move, you might only look for this to happen the first time, and maybe you sell some when it breaks out of a base and it's up, 8 out of 10 days up or whatever. But that generally, as we pointed out before, that's a good sign. When you see 6 out of 7 days, 8 out of 10 days. So what I look for is 70% up days versus down days. So 7 out of 10 days, 5 out of 6 days, that's 70% or more of the up days over a period of 7 to about 15 days. Now, what I find is if you get that to happen a couple times, and you make a pretty good move in the stock, that usually leads to some type of correction in the stock. And if you're a swing trader, you want to be taking that opportunity to sell into strength, and then also looking for the signs that, and these are sometimes subtle signs, and I'll show you right here. So this stock moves up 8 out of 11 days. Okay, so right there, that might get my attention, and maybe I even sell a little bit. Then I get the largest up day. This is what you want to start looking. Once a stock gets extended and it's run up and you get the 70% of the up days, you want to start looking for the largest up day, the biggest spread, the widest spreads, gaps, multiple gaps. And then that's where I would start selling even more into strength and bleeding out of the stock, starting to reduce my position. And then the final straw is when you start seeing reversals or the stock's down on heavy volume. So if it's down on the largest volume, or you get a really big break, this stock gave you almost everything. You got 8 out of 11 days, you got the largest up day, 6 out of 8 days up. Then you get a reversal on the heaviest volume. See right here? That's the heaviest volume that the stock is traded to the entire move. And it's on a big reversal, it's down. And then it makes a nominal new high, but then the very next day breaks hard, and that is the largest price break on the largest volume since the beginning of the move, and that is an outright sell signal. So if the stock's extended, Dave, and you see the largest break on the largest volume, that pretty much is going to get your attention, right?
Yeah, I look for those markers, because that's when you see it, especially on the largest volume that's traded. That's telling you there's some big seller in there. And then also, even if it's not the largest volume traded, but it's the largest volume on the downside that you've seen during that entire move that took place from August all the way through, the middle of October, that's telling you, hey, it's a warning sign. Look very closely for a top to occur.
Right. And just like we were counting the days, when the stock breaks out, remember, I was counting the days for confirmation. So I want to see on the majority of the days up versus down days, good closes. So we're doing the exact same thing here. Once the stock starts getting extended and you get all giddy and happy because you're up 30, 40, 50% on it, whatever, you've got a nice profit on it. This is where you got to really start going to rules and taking a look so you don't get yourself caught up in the emotions thinking the stock's going to go forever. Your goal isn't to, maybe your goal is to find the next Amazon. That's a whole nother game. That's not something that I'm looking to do. I'm trading stocks. I'm trading Amazons and those names, but usually I'm making, I might trade those a whole bunch of times. Like I said, I traded Yahoo, 4 or 5 times. One time was a double, another one was 50, 60%, another one was 30%. When you compound all those trades, I made a really nice move and made a lot of money in Yahoo. But again, you really have to have some rules that are going to tell you when, you got a lot of juice out of the lemon, and now it's time to book your profits. Let me show you some more examples of how this looks in real life. So again, you see stocks making a move here, and then you get 8 out of 9 days up, a few gaps, largest up day, and the widest spread, right? 47% in just 4 days at the end there. So again, this is giving you a whole bunch of, just like the violations that we're looking for after a breakout, these are violations to look at or tip-offs to look at once the stock gets very extended, especially if it's a late stage base and you get this climactic action. Now, selling is a lot tougher than buying and cutting your losses, because cutting your loss, you just set a percentage, boom, it hits that number, you're out, right? Buying, you're looking for that pivot point, and it's much more mechanical. Selling, it's much more of an art, and you're not going to get the high, you're not even trying to get the high. What you're trying to do is nail down a decent profit, get out when the getting's good, and use strength for selling, especially, if you're trading large, this is the thing, you have to get out when you can. I know most of you aren't running a mutual fund or running a hedge fund, although many of you are, but most of you are not. You're individual traders, independent traders. But again, you want to use the same rules. You want to be getting out when the getting's good and not give the stock a chance to break.
And Mark, let me go ahead and show a few things. One thing is, again, how far has this stock gone? This is a stock that was $6 a share in November and now is trading all the way up above 24. So that's a fourfold move. The other thing I think is important to watch on the chart too is just what is the angle of ascent. So this stock is going up at this angle, and then it starts accelerating and it's going up at this angle, and then it's going almost straight up. And when a stock is going almost straight up, it really doesn't last that long. And that's when you've got to be ready to pull the trigger to get out of that position. But just look at the angle of ascent. It's like that plane in those air shows that they do the stalling maneuver. That's exactly what's happening in this stock.
Right. The stock can't keep up that pace. And that's, again, you should be looking to sell into that as you start accelerating, and that gets parabolic. And it shows up. This is something that we can see very, very clearly. Some of you, it may take some time before you see this stuff and you see it very clearly, but we're going to show you more examples here. Sometimes it's a little more subtle than others. But again, you can see, just as Dave said, you've got this angle, and it turns up, and then it really starts to exacerbate itself here. So 11 out of 15 days. You see, this is really a good sign. If this is breaking out of a base, 11 out of 15 days, volume's up, that's meeting Dave's MVP criteria, and that means, that stock can go higher. Then it corrects down to the 50-day here, forms a little cheat area, and then has a really quick run up here, 53% in just 5 days. at the end of that move there. Largest up day, 13 out of 15 days up. After you get extended, you got a gap. So again, you're getting, it doesn't top right there, but usually when you start getting all those violations piling up, it's getting very close. It's getting very close before you either stall out and go nowhere for a while or correct a bit.
Yeah, and sometimes you'll see this too. I call it three moves into a high. 1, 2, 3. It makes two successive higher highs than this, but it just can't go, and it just runs out of gas. And what you'll also see, and you've seen it, I've seen it so many times in this most recent market, is that these stocks continue to try to go, but their relative strength lines are not keeping up, and on a relative basis, they start breaking down.
Right. And another thing that you would look for that is in contrast to a breakaway versus an exhaustion move is that if a stock was breaking out of a base, you would love to see gigantic volume, right? You want to see that huge volume. Well, when you get where a stock's extended and you start getting all these violations that start piling up, now the huge volume is blow off volume. It has a whole different meaning. And you can see here, look at this massive volume compared to all this volume going back. It's just a huge amount of volume. This is telling you that the stock is really now starting to get crowded and getting just way too popular. So again, another thing to look at where you're looking at pretty much the same things that you would look at when the stock initially breaks out, and now they have a completely opposite meaning. Let me show you again here. We'll look at, we'll just get rid of this right there. So this is actually looking at Tesla. Looks like a while back in 2014 when it stalled out and corrected. Again, you came out here, a bunch of gaps. You got the largest up day, widest spread, up 10 out of 14 days and up 51% over a 14-day period. So this was enough to stall the stock out. So again, if you're a swing trader, you'd be selling into this. You'd definitely be selling, or at least selling some. Maybe if you sell half your position, you move your stop up. You probably already moved it up to break even, or maybe you backstop it, and now you can maybe free roll going forward. But again, this is you'd be looking a gift horse in the mouth without taking some off the table here. Another chart here that shows that acceleration, where you accelerate, where your angle. Let me just get my drawing tool here. You can see right here, right, and then look at this. I mean, this right up, boom. And you're coming off of 1, 2, 3, 4 bases, right? And now you go up 58% in just 5 days. Largest up day, widest spread. The largest up day, once the stock's extended, if I see the largest up day and the big wide spread, and I get an angle of ascent accelerates, I'm almost always selling into that. I'm at least reducing the position. Almost always I'm selling into that, or the next day. I'm usually selling into that day or the next day. Within a few days around that time, I start either backstopping real tight and just really starting to try to to hold my gain and to protect my gain at that point, because when they accelerate like this, they could come down very hard, and you're better off getting out into strength and being early sometimes than waiting for the stock to break, and you'll give a lot back in a very short period of time.
Yeah, the other thing that's going on during that climactic period, and I mean, we could use any of these examples, you have to also read yourself. When you start getting so giddy, so happy, the sun's always shining, every day you wake up, you're going, this stock is going to be up. And then you start thinking, well, this is it. I'm going to be a professional trader. I'm just quitting my programming job, and I'm telling my wife that this is full time. That's usually happening right around here. And so you have to also learn to read yourself if you're getting too excited, and you have to keep that head level and just keep on following the rules.
Yeah, absolutely. And that takes quite a bit to be able to move outside yourself like that. And but you'll find that when you're real happy and all giddy and everything's great, Look out. We are not immune from that either. David and I are
Oh,
not immune
gosh.
from that.
Yeah, because it turns into your little, pot of gold. Every morning you wake up and you got more money from that stock, and it's just your little baby. You can't let it go. I can't sell it because it's been so good to me. And so, anyway,
Exactly. Another one here. See, look at how the angle of ascent, the character change, and where you just, I mean, you accelerate to the upside. You get this big gap. It's on earnings. Let's just take a look at the, what happened here. Up 50% in 9 days. Up 7 out of 9 days. Largest up day and a reversal on the largest volume. So you gapped here, but then you reversed off the highs. Yeah, this is just total climax action here. And, again, this wasn't enough to top the stock permanently, but this was enough to stall the stock out for 6 months, where the stock corrected in and didn't go anywhere for about a half a year. Just showing you some different examples here. So another one here, you can see comes out of a big VCP base here. Great, breaks out, looks wonderful here. Now right here, it accelerates and you get a gap. This is where you're getting more of a breakaway move. But as it moves up, 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 now you see it really starts to change that angle of ascent again. Let's take a look here. So we come here, then we come here, and now we come here. Again, you're really starting to move up. Now, largest update, largest spread, big gap, extended in price. You got a big move now. You've gone through a lot of natural reactions too. That's the other thing you can look at. We talked about natural reactions. Look, come in, you break out, natural reaction, natural reaction, natural reaction, tennis ball, natural reaction, natural reaction. Look, all these pullbacks, and now you really, if you held in there all this time, now you really got to do some selling into that strength. Let's see. Let me just move down here. So again, here another way you can look at these stocks to see if they're accelerating is just to draw a line above the highs and make a channel where you start accelerating outside of that. Now you can see that the rate of advance has accelerated. But again, this is the large, accelerates outside that upper line, largest up day, largest spread. You get a big gap. It's very extended. It's made a big move. It's gone through a whole bunch of natural reactions. You got a lot of tennis ball action, and this stock, comes out of this first base here. This is Jack in the Box. I was in this name. Goes from 60 up to almost $100. It's almost a double. So you would be doing pretty good if you're nailing some profits there. So again, these are virtually every one of these are names that I traded, and I was in and did some selling during these periods. Again, just to show you Fear Isaac here. So see, breaks out 7 days in a row up. All right, I'm not selling certainly all the stock there. That's a great breakout from a perfect little VCP. But now you go through a natural reaction, you get back into new high ground, you get a few more of them, and now you get another move, 7 out of 10 days. Now the stock is getting extended. Like I told you before, I generally go through 2 or 3 natural reactions, and then I start looking to sell into strength. That's sort of the textbook trade. That would be a good trade, would be able to get a nice breakout, go through a natural reaction. If it gets into new high ground, great. Hold it maybe for another 1 or 2 more pullbacks. And then as you get into new high ground, sell into that strength. Hopefully I get an accelerated advance and it moves up very quickly at the end. Now I might not sell it all, or maybe I hold it for a larger move. And if I do, then I'm going to start looking also on the downside. All right. We're looking on the upside. We're also looking on the downside. So now we form this, you want to call this a little head and shoulders top, but the real key is we break here, price break. Look at the volume. See, it's the largest volume. That's abnormal. That's very abnormal. Now we kind of roll around a little bit, but then it rolls over. Can't hold the 50-day, and then it just falls apart here. That was your sign, and I should really get my spotlight so you can really see it right here. That was your sign. Again, that's not Aunt Betty. That's not Aunt Betty selling all that, right? That's your sign that institutions are piling out and taking profits, or there's some type of change in the scenario, whether they're going to report bad earnings or they lost a contract or whatever it is. Again, you won't necessarily know. You've got to watch the price action of the stock. Let's see here. So again, this is looking at titanium metals. you know, 8 out of 10 days up, and you get that big volume reversal. Now, this is early on, and it stalls the stock out, right? You get real tight over here, real tight, and then you break out again. Now, here's where 9 out of 10 days up, and then 7 out of 9 days up. So this is that 70% of the days up versus down days. Like I said, if you see that happen a couple times, 2 times, right, I really start looking at selling into strength, look for an accelerated advance, and then I start looking also for reversals on heavy volume, or if I see a large break and the volume's up, I'm out. I'm getting out right away. Usually I'm out before that, but you see right here, reversal on the heaviest volume. So the stock reverses, really heavy volume. Another thing, I don't know how you feel, Dave, about splits now, but how we, I grew up, trading, always looking at splits when we got excessive number of splits, or you start getting those 4-for-1 splits and so forth. That also is a sign that you could be getting late. Why don't you talk about looking at splits?
Yeah, back when I was at O'Neill, I studied splits. And when you get a number of 2-for-1 splits in less than a year, that's usually the marks at top. And that's very, very close to where this marked the top. Now, there are a lot of stocks haven't split in years, but you just had Tesla just had a 5-for-1 split. The stock is down from 500 now to 370. And that occurred right on the day that it split. It started moving back down again. So it's a warning. It's just one other piece of information saying this stock has probably gone a long way, and they're splitting it. And you have to watch the price action a little bit even more closely. But if it's the first split in a while, and if it's a 2-for-1, that's okay. But if it's the second 2-for-1 in a matter of a year, then you have to be very careful.
Right, and two things. Right, Apple also just had a split too, right? When Tesla had a split, and that was also a 4-for-1. So yeah, 2-for-1 splits are better than 4-for-1. So the thing to remember here is that there's no one ring the bell sell, except if you just want a percentage gain. If you are happy with the gain, you risk 5 or 6 or 8%, and you're up 30. Okay, that's a great risk reward payoff. So you'll do fine if you're selling stocks at 20, 25, 30%, just based on, our value or our, a ratio of your risk, 3R, 4R trades. Some people just use math that way. But what I like to do is use it all. And again, it's not like there's any one thing. It's just like with the violations and the confirmations. You're looking for the weight of evidence. When you start seeing the weight of evidence shifting, that's where you start either reducing or selling, and that's letting you know that the probabilities are not as favorable as they were before. Now, I'm going to show you a very simple way to use a selling into weakness rule that I tend to like. This rule. It's a very basic rule. I like to use it in the beginning of a new bull market, in the first stocks that emerge, because you could, when you start a new bull market and you've had a big correction, you've had a bear market, the first stocks that emerge and start coming out of bases early on could be your key market leaders that could make a huge move. And what we found is that those early movers that are the leaders in a bull market, a big part of that move will happen above the 50-day moving average, sometimes before it even closes below it one time. Sometimes the entire move happens above the 50-day moving average. So I came up with a rule that I call it the 50-day break even or better rule. So it's very simple. You buy the stock as it's breaking out of the base, and you set your stop based on your amount of risk, your math. So let's just say we're calling it 8%, 7 or 8% below the buy point. All right. Once that stock, holds that level to the point where the 50-day now catches up to your break even price, I then switch over to the 50-day, a close below the 50-day. So, and that will keep me in the stock. If I'm on a key leader, that will keep me in a lot of these names for a good portion of the move. Now, you can blend this. You might have a quick run up in the stock. Maybe the stock runs up 20%, 25%. I kick out half of it. And then the 50-day catches up, and on the half that I have remaining, I use the break even or better. So now I'm free rolling, and I free roll with a naturally built-in trailing stop. As the stock moves higher, the 50-day will keep moving higher, and it turns into a trailing stop. So you can let me just clear this out here. You can use variations of this, but that's the concept, is to once the 50-day catches up, to switch over to the 50-day one, then it becomes a break even or better stop. So the worst you're going to do is break even, because of course the 50-day is at break even. And again, at the beginning of a bull market, this is when you really want to consider this. Sorry.
Yeah, the only caveat I would add to this is that when a stock goes sideways long enough, that 50-day is going to catch up to it. And as long as it, I mean, and do you agree? Is if the stock is just forming a nice base and going sideways, that 50-day is going to catch up to it like it did here. And I think you can continue to hold the stock even though the 50-day has gone, it's gone through the 50-day, as long as it's still in that base, because then might be a whole new base and then it takes off and goes again.
Yeah, I mean, you're going to use some judgment on this, and especially, usually what happens that I find, especially if you're using this off the bear market lows, and you're getting these stocks that are breaking out of bases, usually the stocks run up and they're up 10, 15, 20%. And then the 50-day catches up and you don't get into that scenario, but you certainly can get into where it moves sideways and the 50-day sort of goes flat. And at that point, you may want to just stick with your original stop until the stock gets at a profit and gets away from your, not only the breakout point, but gets, a multiple of your risk. So again, you can use variations of this. I'm just going to show you a few names and some names that I used it on, and also some examples here. This was a symbol MDVN. I traded this and coming out of this base here, and you can see it's set up. Now, with power plays, and this is a power play, you sometimes could be a long way from the 50-day. The stock will be way above the 50-day. So it might take some time. If you were buying this right here, look how far the 50-day was way, way down. So it took a long time for it to catch up. And that sort of takes care of what, Dave was just talking about, because in order for that 50 to catch up, the stock's going to have to probably go up. I mean, it could move sideways and it certainly could catch up, but it have to move sideways for quite a while. But in this case, you can see the stock's up. Now the 50-day catches up. And now when it crosses that break-even point, there's your break-even point right there. Now you switch over to that, and you see it holds you in here for the grand majority of this move before it rolls over here, and you lock in yourself 100% gain. Now, you probably, wouldn't hold for that. If you'd go through these pullbacks or maybe be so happy with the profit right here that you sell. This gives you a mechanical way to keep yourself in the stock. And like I said, you don't have to do it with the whole position. You can sell part of your position and free roll it. But again, this gives you a more of a mechanical rule. Here's another Foster Wheeler. This came out of a nice VCP, real tight here. I bought this. This broke out on earnings. They reported earnings. It was a gap, but the gap wasn't that big. So I bought this breaking out. You can see pulls back, natural reaction for just 2 days, back into new high ground, natural reaction. Boom. I mean, just comes out of here, and see now the 50-day catches up to the break even. You switch over, and then you lock yourself in a 70% profit here when it finally rolls over. It makes another move, of course, but this is good to help you trail the stock. Again, here another example, Ford. You can take a look at these. Now, another thing, Dave. I want to go. Do you have something to say? I'm sorry. Did I interrupt you?
No.
Okay. So another thing. This is something that Dave pointed out to me a long time ago, and I've been using it in conjunction with the 50-day, and that is just simply looking at a weekly chart and looking for when the stock puts in 3 lower lows. And sometimes this will happen right when it breaks the 50-day. And here's a perfect example of taking a look at Burlington. This is one that David and I were buying coming out of this IPO base. If you take a look through this whole move, it only has 2 times where it has 2 lower lows. The rest of the time in this move, you never even get 2 lower lows, let alone 3. When it finally gets 3 lower lows, it gives you a weekly close below the 50, and that's the majority of the move is over. So you see how this very nice, efficient move all happens above the 50-day, and it all happens with no more than 2 lower lows the entire time. So now one of these might happen before the other, or they might happen at the same time. So how will I handle that? Well, I mean, if it, I get 3 lower lows and I'm seeing some of those selling signals that we talked about earlier, I might reduce. Maybe I sell half of it. And if I get it all at once and it closes below the 50-day and I get the 3 lower lows and I'm getting those, I might blow the whole thing out. But again, the weight of evidence, taking a look and looking at the weight of evidence here. Alibaba. Here's another one that came out right here. Comes out of a big cup with handle, nice VCP action. We're looking at some weekly bars now. These are weekly charts. Look at this, how this stock comes out. And again, there's never even more than 1 lower low up until here, and you get 2 lower lows, and then it keeps going. So you would stay, if you're using 2 lower lows, waiting for 3 lower lows, you're in this entire time, which comes out at 105 or so, and now it's up at the 185 level, and you're still in the stock. It's still holding the 50-day, or in this case the 10-week, and it still hasn't had 3 lower lows. So just using those 2 simple rules, you're still in this name, and you could use the break even or better rule too.
Yeah, and I would add that those 3 lower lows, like here's 1 and here's 2, that even these are not very. Usually like to see if it's really changing. The 3 lower lows are along with a little bit more price action and an increase in volume on the downside. But if there's 3 lower lows and the stock has barely moved much, I wouldn't even consider that.
Right. Right. And again, like I said before, Dave's been doing this for the better part of, 45 years or so. I've been doing it for 37 years. So we're trying to make this as, as clear as possible, but there's a lot of art to this. There's a lot of things that, we can see and we have a lot of experience to know, that action still is not too troublesome. But Dave likes to call these looking at volume markers, price and volume markers. And so that's why I always look at a weekly chart. I always look at a weekly, even though I'm zooming in on the daily and I'm looking for that VCP and really getting very forensic. I always look at the weekly chart and I want to see the weekly, and I start looking for these volume markers and how many lower lows and so forth. So you put all this together, and these are, you got to think of these as like tools in your toolbox. If you were to build a house, you wouldn't just use a screwdriver. You would have all kinds of tools. It's the same thing with stock trading. You're going to have all these tools and all these things to look at. The key is that it may sound like a lot, but it's really not. We're really boiling this down to just a handful of tools, but there's a million things that you could be looking at. The key is to not try to understand everything or to know all the things that don't work. There's a million things that don't work, but there's a small handful of things that do work. So we're trying to get you to gravitate to the things that are important, the things that are meaningful, that are really going to tell you whether a stock's acting normal or not, if the earnings are truly, breaking out and there's a change in character and there's true acceleration, the things that actually work in the marketplace, not based on Dave's opinion or my opinion, but based on facts, based on what we've seen. Big moving stocks and fast moving stocks, what influences them, and what are those tracks in the snow, if you will, that we've been following, for our entire careers, most of our life. Actually, I've dedicated the majority of my life to the study of stocks. So again, just showing you a few more examples. We don't have to go, over these ad nauseum. But again, another stock here you can see comes out of a cheat area here, looking at a weekly, another base here, the whole time holding the 50, or in this case, again, the 10-week, 2 lower lows, right? You get 2 lower lows. You never get 3 lower lows. See, that those few rules keep you in this stock the entire time. Now, I'm going to reiterate, these are best used at the beginning of a new bull market. After you get a correction in the market, and usually a significant correction, the bigger the correction, the better, because that's a washout. And now you get some new leadership. You could be on a key leader. And if your goal is to hold, some of you might want to just short-term trade, and you're going to be taking profits at, your average gain might be 8 or 10 or 12%. But then there's going to be some of you that want to go for those much bigger moves. You'll have more trading if you're taking the smaller gains. You'll have less trading this way, but this way you're going to give back a lot more. Sometimes you're going to have to give back a good portion of a gain that you would have nailed down if you were a short-term trader. And that's the cost of doing business. So there's multiple ways to skin the cat. All right. But we're going to give you the tools to look at, to do it in several different ways around using the same concepts. Shopify came out really, really nice defined base here, right? Tightness on this right side comes out. And again, 2 lower lows here. You never get more than 2 lower lows. Yeah, and now you do get a close here below. You get a weekly close below the 50-day. But again, maybe you sell part of your position there, and you're waiting for 3 lower lows. You'd still be in the stock moving from $40 above 110. Gives you some mechanical rules. So the real key is to sell extended stocks. Buy stocks coming out of bases. Never chase and buy extended stocks. That's where you're looking to sell. Get out when the getting's good. Sell into strength. I'm always looking to sell into strength. The last thing I want to do is give a stock a chance to break. Let me explain to you why it's so important to sell into strength. If you sell into strength, you're selling at your equities high. So if you bought the stock at, let's just say you bought this stock here at, let's call it 45, and you sell it way early, all right? You sell it at $70, which is a nice move, all right? Or even over here at $60. It gets extended right here for that 1 week. You sell here at $70. Okay, the stock goes on to make a much bigger move, but you sold at the highest price that stock was trading since you bought it. So what does that mean for your equity curve? No drawdown, 0 drawdown. You're selling at the highest price. If you give this stock a chance to break and come in, now you get drawdown. Now, what if you own 10 stocks and the market corrects and you let them all come in? Now you're going to have a good sized drawdown. So I'm always looking to sell into strength because I don't want to have any drawdown. I want to have all equity highs, and I want to just see myself go up, 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 get out of my stocks, and then go sideways in cash, and then do it all over again. I want to see that stair step up. That's what I want my equity curve. I want my equity curve to look like a good performing stock in a stage 2 uptrend. So this is my equity curve. I'm in cash. Then I'm in stocks. Moves up, then I'm in cash, right? That's what I want my equity curve to look like. You achieve that by selling into strength and not letting volatility whip you around.
Yeah, and I would add that you sell into strength, but if you've got a really good stock, if it's made a great gain, but it just gets temporarily extended, then you can take part of your position out. You don't have to sell the whole thing. I wouldn't recommend, especially if you found something that has got great earnings, it's in the right group, it's been super strong. You don't want to completely lose that position, but maybe sell down to where you can go through a correction or a sideways movement and then buy it back after that base is finished.
Right. You're in the early stages, right? You have a stage 2 uptrend. You're coming off of a bear market, and you're coming out of a first, or second base. That may not be the time to go and sell the whole position. If you sold Amazon, off the first or second base, you would have left, I don't know, 80,000% on the table maybe. So as Dave's saying, trading is not an on or off business. It's an incremental business. You don't have to buy or sell the entire position at one price. And again, it's about the weight of evidence. However, you're in a 5th stage base and you got a really big move in the stock, and the stock breaks and gets below the 50 and it's heavy volume and there's 3 lower lows. Okay, there's a lot of evidence, and you've got a lot of gain to lose. You have something to lose now too. You've got this big gain. You've accomplished your goal. You've made a nice profit. Now you go into protection mode. Okay. So again, I want to, and I've said this before and I'll say it again. a lot of trading. We're trying to give you a lot of mechanical and black and white answers, but a lot of stock trading is art. And here's the good news. If it wasn't art, there'd be no opportunity. Let's just say it was pure science and you can calculate everything and make it purely mechanical. You put it into a spreadsheet, guess what? Computers would be able to, you program everything and a program could run it and it would take every inefficiency out of the market, and the market would be truly random. The reason why there's such unbelievable potential in the market is because it's art, because there's part of it's art. It can't be completely quantified. That's the beauty. That's the opportunity. So you don't want it. You don't want it. You don't want all the answers. If you got all the answers, there'd be no opportunity. That would be the end of it. And accountants would be the richest people in the world. A good number of crunchers would be the richest people in the world.
Yeah, and I think a lot of people have tried to do that and have gotten almost so far on the analytical side with all the computers and spreadsheets and things like that now, that the art is actually being lost. They're getting it. It's getting too quantified and not more of a feel for what is going on in the stock price itself.
And we see that all the time. We saw that with long-term capital. We said where we get these super bright individuals and they think they can figure everything out and put it on a slide ruler and a calculator and a computer and a spreadsheet. And it always ends up blowing up, always, because there's no way you can come up with an answer in perpetuity for stock trading. And that's all there is to it. So, and that's the beauty. And that's why 37 years later, I'm still in the business and able to make great money and to teach people to do this and to do great. And it'll be going on long after I'm gone and Dave's gone. So we're going to wrap this up right now and we'll be back. But right now we're going to take a break and we'll be back. Okay. Let's take a break here.
Okay, guys. Sorry about a little bit of that mismatch, but we're going to take the break. That was identify top base count, PE expansion, climatic run, days up, 50-day break even rule, differential disclosure. This is all part of the selling criteria, obviously. And when we take a break here for about 3 minutes, let's try to do 3-minute break is where we will come back and then just cover the squats and reversal recoveries. Again, that section will be the last section rather for this session. It will be about a half an hour in length. And of course, this will all be available for the evening session at 6 o'clock tonight for replay. So let's just take about 3 minutes and then we will be resuming with the last section of today's morning session of day 3. Thanks.